Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Good morning and happy Friday. Today will be the 6th of December 2024. So before we start, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So before we start, let's make sure that everything is good in terms of the voice check, and as well as the screen of my monitor is working pretty fine. Okay, just 1 second. Let's make sure that everything is okay. All right, I think everything should be fine and working over here. Yeah, I think it should be everything should be all good in terms of the sound check and the screen. All right, so as usual, let's kickstart with what has taken shape yesterday in terms of the intraday movement on the broad-based cross asset classes, and as well as its relevant intraday news flow and key economic data release. All right, so let's start with the performance of the US market first. All right, so for the US market, yesterday is more like a profit-taking day. We know that the US major stock indices has been rallying on the average in terms of a short-term trend since 5th or 6th of November, where Trump got re-elected. American first policy outperformance supports the outperformance of the major US stock indices against the rest of the world. So yesterday we see a bit of we call it a consolidation, where I would say that pullback or profit taking, where the SPX, the Nasdaq, the Dow Jones, and the Russell 2000, all of them close in the red, right? So the SPX is down by negative 0.19%. The Nasdaq 100 is down negative 0.31%. The Dow Jones is down negative 0.55%. The Russell 2000 underperformed with a loss of negative 1.25%. So what we could see over here is that yesterday that drag down on the major US stock indices has also been primarily in the culprit of the mega cap technology stocks that has been outperforming since the start of this week. All right. Okay, so that's profit taking over here. So what we could see over here is that two mega cap technology stocks, the Google and Meta, actually fared the worst among the 7 mega cap technology stocks within the S&P 500, leading to this profit taking activities that has taken shape. The so-called the performance of the intraday US session yesterday. So net overall, later I'll share with you on the short-term intraday technical outlook on the major US stock indices when I covered the Dow Jones and the Nasdaq 100. So those who followed our daily dose of market insight yesterday, we do highlight there's this possibility of that pullback, minor pullback, but still holding their respective key support level. So that pullback actually taken shape yesterday, all right, during the US session on the Nasdaq 100 and the Dow Jones Industrial Average. So more about that when I touch on the intraday technical outlook segment on the major US stock indices. So as for the dollar, so if you look at the dollar index over here, the dollar index yesterday actually fell as well, right after trying to actually surpass the 20-day moving average. So the dollar actually fell by negative 0.6%, but still managed to hold above a key short-term support level at the 105.48. So what is 105.48 is this green line, this gray line here was that former key major trend line resistance that resisted it previously on the both occasion on the April 2024 June 2024, and finally it did that bullish breakout on 13th of November, exposed Trump won on the US presidential election on the 6th of November on outcome, and now it's shaping that pullback to retest that 105.48 level. So yesterday's lackluster dollar movement, the US dollar index movement, or the dollar strength, lackluster dollar strength, was more of a, what you call it, so-called the calmness that has taken shape in the French economy. So yesterday, let me highlight to you. Okay, so yesterday the France president, he didn't actually step down. Okay, so he votes to actually serve the remaining term of his term presidency. So okay, so in France, it's a bit strange. The president and the parliament voting date is different. Two different date and different year. So the France president election will only come in 2027, so it's only 2 years from now. So despite that, Macron political party and its ally is getting very less voice. Its voice is getting lesser and lesser in the France parliament, because right now the France parliament is skewed towards either the far left or the far right. So Macron is being the center, and what we could see at the start of this week is that the far left and the far right political parties in the French parliament vote to actually topple down Macron's appointed French PM to run the government. So right now there is actually no French PM right now, and Macron actually vote to actually step up and appoint a new PM as soon as possible. All right, so he didn't vote to step down, so that actually kind of cool down the political uncertainty in the France economy. That also causes the dollar's strength setback story to actually be more muted yesterday, where the dollar index is down by this negative 0.6%, but still holding above a key support level at 105.48. All right, and also on top of after we call it Macron's speech, the far right leader Le Pen, who has a very strong say in the France parliament right now, and because of her backing, the they the far left and the far right managed to pass this no confidence vote to remove the France PM, right? The previous France PM. So the far right leader, she's really out her condition for supporting a new budget over here, and she did mention that say that the France could develop the France government, that means the new government with the new PM, is able to develop a budget in a matter of weeks, as long as the next PM is to narrow the deficit more slowly. So it seems that based on her message over here, she's willing more or less to be less rhetoric against the new PM, as long as this new PM hears or adheres to her request. Right, but the big risk over here in terms of the market perspective, if you look at the price movement of the credit risk premium in the French economy, as depicted by the spread between the 10-year France sovereign bond yield against the 10-year German bond yield, it still remains elevated, even though it came down slightly below the 0.81% that was made at the start of this week. All right, this week is 0.81%. So now it dips slightly below to 0.78%. Okay, but it still remains rather elevated as it continues to see a series of lower high over here. So the trend, the medium term trend of this bond yield spread between the 10-year France government bond yield against the 10-year German bond yield is still indicating a rather elevated credit risk premium of holding France sovereign bond yield, or holding a France sovereign bond, which means that there is still heightened risk of credit risk premium inherent in the French economy. That means, i.e., this particular credit risk premium is not actually shaping downside. That means there's no clear bearish reversal. If this thing were to continue slowly tick upwards towards the 0.98%, which is the key medium-term resistance next on this credit spread between the 10-year sovereign bond of the France government bond and the 10-year bond yield of the German bond. That could inflict downside pressure based on the intermarket analyst perspective on the euro dollar that continues to still inch downwards on a weekly basis, and as well as the euro Swiss right now is actually threatening to break below multi-decades lower. So the current low that was seen at the end of December 2023 is now attempting to break below it as well. So net overall, in terms of price action from transactable instrument that represents or give us a gauge about the current political climate in the French economy, it seems that the political fiasco in France is not yet over, despite that rather calm dovish calm rhetoric that is being smoothed out by the French president yesterday and as well as Le Pen. But the price action of the respective relevant market transacted instrument is not saying that. That means what I'm trying to share with you guys over here is that yes, there appears to be calmness on the surface, but underneath there could be still be cracks forming in the political climate on the French economy that could potentially see a further uptick in the spread of the France sovereign bond yield against the 10-year German bond yield, which represent a heightened credit risk of holding on to France sovereign bond instrument. If it starts to hit up the 0.98% on the spread, that could actually start to see further downside pressure on the euro against the dollar. But the much more risk sensitive euro Swiss FX cross rate has already indicated that it's about to potentially break further lower low to see multi-month or multi-year decade low. It was right now is testing the low of 25th of December 2023 right now as we're speaking. So something to take a note of. All right. So that's happening in the FX market over here. And what's for gold? Gold yesterday also continues to trade lackluster. So gold yesterday fell by 0.6 or 0.5% to 0.6% during the US session. Still failure to break above the 50-day moving average, which is holding on as a key pivotal resistance level at the 2,666 level. All right, so later we'll touch on more about the gold chart when I share the intraday technical outlook picture of gold. Then what we see over here is also there's a key Bank of England official. So why this lady is important? She's a official. She's not the governor. She's one of the official in Bank of England that is part of the rate setting committee. So BOE Greenie actually warns that growth drag from mortgage rate will persist. So she actually gave up a rather dovish message. So she said that it will take time for a consumption recovery in UK. So why her speech of important? Because previously she's seen as one of the more hawkish member within the rate setting committee. All right. So previously, Greenie is seen as one of the more hawkish voices in the 9-member Monetary Policy Committee. That means this committee decides the interest rate setting in UK. So definitely Bank of Governor Belly will have a more say, but she's also very important because previously she's more hawkish, and right now, based on her current rhetoric, she's now skewing towards more of a dovish side after she joined the majority in the voting of a rate cut in November. All right, so that also causes the sterling dollar. So the sterling dollar, let me share with you immediately the chart of the sterling dollar. So the sterling dollar yesterday tried to actually did a push up above our short-term pivotal resistance at the 1.2750. Then after her speech, the sterling dollar seems to try to trade sideways, preventing the boost from breaching that 1.2750 level based on the news flow. Relevant news flow coming out from the rather dovish speech from Bank of England official Greenie. Okay, that I shared about earlier. Right, so later I'll touch on more on the technical outlook on the sterling dollar. And another news flow I share about is more pertaining to the oil market. So the oil market or the oil market yesterday continues to slide. The WTI West Texas crude oil declined by close to negative 0.5%, and most importantly, it erased off that earlier gain, about the 2% gain that was seen earlier on Tuesday, when there was a news leak stating that OPEC Plus would continue to delay its supply output hike down the road into March next year. So what the oil price market yesterday faced, or the West Texas crude oil market faced, was due to this HO buy the rumor, sell the fact story. So after the meeting concluded yesterday, so OPEC Plus concluded its meeting, and it actually more or less came in within market expectation. It actually decided to delay the revival of its oil production by 3 months. So market is now looking at likely to be unwound from April at a slower pace. All right, so that actually saw oil prices selling off because there's no new, that's already being priced into the market. All right, so later I'll touch on more on the West Texas crude oil. Where are we potentially heading from a short-term intraday perspective? All right, so that actually sum up the key intraday performance that I'll share with you guys pertaining to the relevant news flow or its respective news flow that has taken shape yesterday. All right, so now let us now straight away, of course, there's no key, very interesting intermarket dynamics I'll share with you guys. So the intermarket dynamics I share with you guys will be the relationship between the Euro Swiss, the Euro dollar, and this continuous high elevated yield spread between the 10 years France sovereign bond yield and the 10-year German bond yield, which I covered earlier on during the first segment of my daily dose. Okay, for today. So now let us now jump straight to the intraday technical outlook. All right, on the FX major dollar pair. Okay, starting with the euro dollar. So the euro dollar continues to struggle. What we could see over here is that yesterday it tries to push, but it can't break above the 1.06 short-term pivotal resistance level. So we know that today market will be looking at a rather key US data, which is the non-farm payroll data that will be out later in the evening Singapore time. So later I'll share with you what is the market consensus on the non-farm payroll data. But markets still, the euro dollar still can't break above the 1.06 figure level. But what I'll do over here is that I will have a downside trigger level to maintain our intraday bearish bias. So the downside trigger level will be at 1.0530. Only a breakdown below 1.5030 will reinforce that bearish bias to give a further impetus for the intraday bears to revisit 1.046 and even 1.0410 on the intraday basis. So still maintaining that intraday bearish bias on the euro dollar. The new fact is that I added in a downside trigger level at 1.0530. Only a potential push up and an hourly close above 1.06 figure level, that's our short-term pivotal resistance, will invalidate the status of this intraday bearish bias to see the continuation of the extension of this minor mean reversion rebound that has taken shape since the low of 22nd of November to extend it much further for the next near-term resistance to come in at 1.0660 slash 1.0680, and above it potentially sees a visit on the key medium-term pivotal resistance at 1.0770, which confluence with the downward sloping 50-day moving average. Right, so that's for the euro dollar for today. Now, turning our attention on the sterling dollar. So the sterling dollar yesterday's struggle above the 1.2650 level. And what's interesting over here is that the hourly RSI has started to shape a lower high over here, and it also broke down below a parallel key minor ascending trend line support over here that I drew from its low of 2nd of December. So yesterday it staged a breakdown below it. So with that lower high and that bearish breakdown of this parallel minor ascending trend line support on the hourly RSI of the sterling dollar, it indicates that the yesterday's push up lack of bullish momentum. So with this negative aspect on the hourly RSI on the sterling dollar, I will still maintain that intraday bearish bias on the sterling dollar, keeping a bit of excess yesterday above the 12750 short-term pivotal resistance, which is at 1277 figure level. Yesterday's intraday high that was actually seen at the first half of the US session yesterday, but I also do have a downside trigger level to watch out for today. Okay, will be at 1.2720. So only a breakdown below 1.2720, the downside trigger level potentially exposes the next near-term support level to watch on the intraday basis. On the sterling dollar will be at 1.266 figure level. So this 1.266 figure is rather key because this is a minor ascending trend line that is still in place since the low of 22nd of November. So if we could start to see an hourly close down below 1.2660 figure level, also given that the fact that today there's a key risk data that impacting the FX market, which is the NFP data from US, the important job data from US that could actually trigger the start of another impulsive downward sequence on the sterling dollar to revisit 126.10 nicks and even 125.10 nicks from a multi-day perspective. All right, so these are the key levels to watch on the intraday basis. But however, if price action starts to have hourly close above 1.2770 short-term pivotal resistance, that's the excess, then today's intraday bearish bias will be invalidated to see the extension of the mean reversion rebound continuing towards the next near-term resistance level at 1.2840 and even 1.29 figure next, which correspond to the downward sloping 50-day moving average. All right, so that's for the major European currency against the dollar. Now, turning our attention will be the Asia Pacific currency, starting with the Aussie dollar. So the Aussie dollar yesterday, we do have a bearish bias, and price action indeed still remains muted. Can't actually surpass our short-term resistance yesterday we have was at 64.80. So price action seems to be now trading below this minor descending trend line, descending channel that is in place since the minor inflection high of 29 of November, where price actually starts to inch down much lower. So using the upper limit, pardon me, of this minor descending channel, which also correspond to the previous minor swing low of 3rd of December and 4th of December, that almost was made yesterday before that sell-off take shape in today's Asia session, while we are as 1 hour before the daily dose. So using a Titan key short-term pivotal resistance for today at 0.6460. So as long as this Titan short-term pivotal resistance holds at 64.60, we will still maintain that intraday bearish bias on the Aussie dollar. For sure, the first support will be 64 figure level that managed to survive on Wednesday. Only a breakdown below 64 figure level will expose the lower limit of the major support zone at 63.60. So why this 63.60 is important? Flashback again on the daily chart, which has been doing so since the start of this week on the daily chart of the Aussie dollar. So 63.60 is the lower limit of this major zone over here. So why is it important? Because it managed to survive on the sell-off on 13th of November, survived the sell-off again on the 19th of April, and most recently survived the sell-off on the 5th of August. So for sure, if we have a very clear daily close today or even a weekly close, because today is the end of the week, below 63.60, then that could potentially unleash a major bearish impulsive movement that could potentially last multi-week to multi-month on the Aussie dollar, given that it has been consolidating since the low of 13th of October 2023. So that's about a year ago. All right, so that's for the Aussie dollar longer term chart, explaining to you guys why 63.60 is a very important support level on the Aussie dollar. So however, if price action managed to survive and stage a bullish breakout of the hourly close above the Titan key short-term pivotal resistance level at 64.60 today, then we could kickstart another minor mean reversion rebound scenario, revisiting 65.10 and even 65.45, which is the 20-day moving average, acting as a resistance, and as well as the minor swing high of 20th of November and 25th of November. Right, so that's for the Aussie dollar. Turning our attention lastly will be the dollar yen. So the dollar yen continues to remain lackluster, can't break above 150.70 yesterday. So, and as well still holding above the 50-day moving average, acting as a resistance, and also confluencing with the medium term descending channel upper limit since the high of 20th of November. All right. Okay, so it's in fact it's a minor descending channel because it haven't stretched out to more than 4 weeks. So, but nevertheless, this level here seems to be a important intersection point, 50-day moving average, and as well as the upper limit of this minor descending channel. So I'll be using a Titan key short-term pivotal resistance for today, 15120. Slightly above 150.70, still maintaining that intraday bearish bias on the dollar yen. First support level to watch remains unchanged, which is yesterday level at 149.60. A breakdown below 149.60 exposes 3rd of December this week minus swing low at 148.85. All right, also only a breakdown below 148.85 potentially trigger a much more pronounced impulsive downward sequence to revisit 147.25. So what's 147.25 is in fact close to the 2.618 Fibo extension level and the minor congestion area of 3rd of August and 3rd of October and 8th of October this year. Only a push up with hourly close above 151.20 will negate today bearish bias to see a squeeze up to revisit the 200-day moving average, confluencing with the next near-term resistance zone at 15190/15215. Above it sees the further mean reversion extension, rebound extension towards 15330, 15370, which confluence with closely with the downward sloping 20-day moving average. So still maintaining that intraday bearish bias with a tightened key short-term pivotal resistance at 15120 on the dollar yen. All right. So one particular interesting FX cross pair I want to share with you all is more pertaining to the ongoing Aussie weakness will be the Aussie yen cross pair. So this Aussie yen cross pair continues to trade below the lower half of this minor descending channel since the low of 20th of November. So price action, I will use this RSI. So if you look at the RSI over here, RSI has started to shape a lower high. Okay, what you could see, and also the RSI also has staged a bearish breakdown below this key parallel trend line support level, indicating some signs of bearish momentum has started to take shape on the Aussie yen, despite the fact that the minor sideways movement is still inherent in the Aussie yen since the low of 4th of December. So we know that RSI tends to give a bit of leading element because it's a derivative of price action. So given this potential resurgence of this downside or bearish moment, short-term bearish momentum that could start to creep back into the Aussie yen as depicted by the current bearish condition, as I share with you on the hourly RSI, we will use 97.15, which is the upper limit of this minor range configuration, as my short-term pivotal resistance level, 97.1515, bearish bias. Below 95.10 exposes 95.30 next. So 95.30 will also correspond closely to the lower limit of this minor descending channel as it's going to run down, and also confluence with the minor congestion area of 17th of September and 18th of September. Only a hourly close and a push up above 97.15 invalidate the bearish bias and start to kickstart a mean reversion rebound scenario, exposing the next near-term resistance in first step 98 figure followed by 98.70. Okay, so that's for the Aussie yen shaping up potential intraday bearish element that we could keep a close watch on for on a short-term basis. Okay, so now let us now turn our attention towards the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 for today is just did a push up right now, so we're going to respect this push up over here. So it seems to be that market is now having this rumored that next week there will be this meeting pertaining to the economic we call it work pants symposium of key policy makers that will gather in this economic symposium in China to lay out the economic strategy next year for the Chinese economy. So there's this rumor that's stating that there will be much more forceful stimulus again that is coming out from the market. So given the fact that the price action now has started to push up above the 20-day moving average and also above the 19,880 level, so we got to respect this price action, and we will flip to a intraday bullish bias to play along with this price action, positive price action that is taking shape on the Hong Kong 33 right now. So I will use a very tight short-term pivotal support for today, which is this intraday low, and also confluence with the 20-day moving average and the minor ascending trend line that is still in place since the low of 26th of November. All right, so this level here will be my short-term pivotal support level, 19,570. All right, let me put it in writing. Okay, 19,570 short-term pivotal support level. Next resistance level to watch will be 20,150 for today. Above it potentially sees 20,490. So 20,490, if we do the Fibo retracement from the previous sell-off of 8th of October all the way down to the low of 26th of November, that corresponds to the golden ratio of 61.8%. All right. So, but however, if price action for today starts to break down again and close below, have an hourly close below 19,570, so that is considered as a failure bullish push up, and we will start to see choppy price action again taking shape on the Hong Kong 33 index to revisit the minor swing low area of 22nd of November and 27th of November, I think as a next support level at 19,080. All right, so that's for the Hong Kong 33, flipping to a intraday bullish bias given the current positive price action that is taking shape right now, using 19,570 as my key short-term pivotal support level. All right, so before I touch on the Nikkei 225, let me expand my screen so that you guys can have a better view of the chart. Right, so for the Nikkei 225 over here, price action has now starts to tumble as expected. All right, so it's now almost coming close to the support zone at 38,830, 38,670 over here. And given that now it's coming to Friday, so what I will have over here is that because since it's coming very close to the support level already, I will flip to a neutrality stance for today, given that it's Friday. Right, so instead of having that bearish bias, okay, so neutral between 39,380 and the lower limit of the neutrality zone. Okay, will be at 38,830, 38,670. So only a price action breakdown below 38,670 will potentially validate a further potential bearish bias on the Japan 225, i.e. the Nikkei 225, to expose the next near-term support level at 37,980. Then, however, if price action managed to see a breakout above the 39,380 level, upper limit of today's neutrality range, potentially sees upside momentum coming in on the intraday basis, but still within its complex sideways range configuration. Next resistance to watch, 39,840. The complex range configuration key resistance level still remains at 40,155 slash 40,280. Right, that has been resisting previous price action since 15th of October. So this is the complex range resistance that the Japan 225 is still trading in. All right, since the low of 27th of September this year. Right, so flipping to a neutrality sense for today, since that price action is coming very close to our support level, we should show confluence with the 20-day, 50-day, and the 200-day moving average at 38,830 slash 38,670, lower limit of our neutrality range. Upper limit of our neutrality range will be close to today's intraday session high, 39,380 during the Asia session. Okay, now turning our attention will be the German 30. So the German 30 continues to rally out as expected and now hit the resistance level, which is the upper limit of this minor ascending channel, and as well as the upper limit of the major ascending channel that I have drawn from the low of 4th of October 2022. So that's almost 2 years ago level element. All right, since it's coming very close to this key resistance level at 20,390, 20,470, coupled with a bearish divergence that's being depicted now on the hourly RSI, potentially the German 30 now could faces a risk of a minor mean reversion decline scenario to revert back towards this empty space over here, where price action has to start to trade a fair bit above the 20-day moving average and above the 50-day moving average. All right, the medium-term trend is still up. It's only that in the shorter-term perspective, because it has risen too much and it's now coming close to a pivotal intersection point, coupled with a bearish divergence on the hourly RSI, we will flip to an intraday bearish bias for today for that potential intraday mean reversion decline setback scenario that may unfold. 20,390 slash 20,470 short-term pivotal resistance level. First support level to watch on the intraday basis for this potential intraday mean reversion decline scenario, not rebound scenario, mean reversion decline scenario, pardon me if I was to mention wrongly at the start. 20,155, a breakdown below it exposes 20,010 next. Only an hourly close with a push above 20,470 will invalidate today's intraday bearish bias to kickstart another round of impulsive up move sequence to expose the next short-term resistance level, which being defined by a cluster of Fibo extension level and cluster 20,550 followed by 20,650. So I repeat again, given that it's coming very close to a clear key intersection point on the upside, using 20,390 / 20,470 as my short-term pivotal resistance level, coupled with a rather bearish condition on the hourly RSI, will flip to a intraday bearish bias for a potential mean reversion decline scenario that may occur on the German 30. First support level to watch 20,155 followed by 20,010 next. All right. Now, turning our attention, next will be the major US stock indices, starting with the Dow Jones Industrial Average, the US Wall Street 30. So the US Wall Street 30 yesterday at the start of US session retested the first resistance level again at 45,070, come break through and shape that pullback, hitting the first support again at 44,730. So still no change, still using 44,520 as my short-term pivotal support level. And right now the 20-day moving average is also coming very close to act as a support level, similar support level as well. So 44,520 short-term pivotal support level, still maintaining that intraday bullish bias on the US Wall Street 30 after yesterday's profit taking scenario that takes shape. First resistance level to watch 45,070, only a breakout above it potentially sees 45,450 next. However, if price action starts to close down, a breakdown for hourly close below 44,520, that would invalidate today's intraday bullish bias to kickstart a much more pronounced mean reversion decline scenario to expose the next near-term support level at 43,980, 43,807 next on the US Wall Street 30. Now, turning our attention now will be the the Nasdaq 100, pardon me. So the Nasdaq 100 indeed shaped that pullback that we expected at the 21,500 resistance level that we highlighted earlier on. All right, so the hourly RSI hasn't hit the oversold region yet, so potentially there could be still some more room to fall for this minor pullback scenario to play out for today. First support level to watch out for will be at 21,320. The next support level will be the key pivotal support level that we highlighted yesterday, which is the former all-time high area tested earlier on 3rd of December before shipping that bullish breakout on the 4th of December. All right, so as long as this minor pullback didn't surpass below 21,220, so around this zone over here, potentially we could see a resurgence of the impulsive upmove sequence coming back into the Nasdaq 100 again. So as a start, potentially there could be still some form of minor pullback sequence that could still continue to unfold because the hourly RSI hasn't hit the oversold level yet. Potential support level to watch for that minor pullback scenario to continue to play out today on the intraday basis ahead of the non-farm payroll data release, 21,320, 21,220 maximum, which is our short-term pivotal support level. So as long as this short-term pivotal support level holds 21,220, thereafter potentially we could start to see a potential bullish reversal coming back into the Nasdaq 100. First resistance level to watch for sure will be at 21,500, followed by 21,650. Only if we start to see a push down with hourly close below 21,220, then that minor pullback could extend to form into a much more pronounced mean reversion decline scenario to revisit the 20-day moving average, I think as a support area, 21,100, followed by the 20,970 / 20,880 next, which correspond to the rising 20-day moving average. All right, so that sum up the intraday technical outlook on the major stock indices. So now let us turn our attention and focus to the commodities market, starting with the gold XAU/USD. So for gold XAU/USD, price action continues to remain lackluster. Hit the support zone, all right, during Asia session 2,622, 2,600, 2,590 before staging a bounce right now after hitting the oversold region. So what you see over here is that the price action on gold, yes, it hit oversold, but there is no bullish divergence over here. Okay, there's no bullish divergence. So representing that it's just trying to rework itself out of its short-term oversold condition by staging that bounce back up again. So still no change, still using the upper limit of this sideways range, 2,666 short-term pivotal. Okay, let me remove this. So this should be 2,666. Okay, to prevent any confusion. Okay, 2666 will still be my short-term pivotal resistance level, the upper limit of the range, minor range configuration that is still in play since 29th of November. Lower limit of that range configuration will still be my support level to watch. 2600, 2590, only a breakdown below 2590 potentially sees a bearish breakdown to extend this multi-week potential corrective decline sequence that is still potentially still at play on this Go XAU slash USD to expose the next resist support level at 2546 slash 2526 next. All right. So, however, only hourly close above 2666 will invalidate today's intraday bearish bias to see a recovery in gold in first step towards the next intermediate resistance level 2689, followed by 2728 slash 2715 on the intraday basis. All right, so that's for gold XAU slash USD. Lastly, West Texas crude oil. So for West Texas crude oil over here, what we could see is that price action continues to totally erase Tuesday push-up news due to the rumor that OPEC Plus will delay its rate hike, not delay its supply output hike, and that actually took shape, and the West Texas crude oil fall off to the OH policy of sell the news by the rumor scenario. So key level to watch out for today is the 20-day moving average that price action refused to break out yesterday. All right, and shape that push down. So this 20-day moving average will be used as my short-term pivotal resistance level at 69.30. So 69.30 short-term pivotal resistance level, maintain the intraday bearish bias. First support level to watch will be 67.90. A breakdown below it exposes 67.55 slash 67.10 next. All right, and below 67.10 will expose the lower limit of that major support zone at 65.70. So what's 65.70? So 65.70, if you look at the daily chart of West Texas crude oil, is the lower limit of this major descending triangle range configuration that is still intact since the low of 20th of March 2023. Right, but however, if today's intraday price movement managed to shape a bullish breakout and hourly close above 69.30, then today's intraday bearish bias will be negated to see a push up to test the 50-day moving average, acting as a resistance now at this 70.80 level. Okay, let me put it in better perspective again. Okay, so this will be no longer a short-term pivot. So today we have a tighter short-term pivotal resistance, which is the 20-day moving average acting as a resistance, 69.30, maintaining that intraday bearish bias. So only a breakout above 69.30 will negate today's bearish bias to see a push up to revisit the 50-day moving average, acting as a resistance at 70.80 next. Right, so that's for West Texas crude oil, and also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's take a look at the economic calendar. What are the key data to look out for? So like I mentioned earlier on, for today, today's key data will be pertaining more on the US data. So let's take a look at the European session. So European session, what are the key data to look out for? This is rather second tier already, because this is the third estimate, or even third tier as well, because this is the third estimate of Q3 GDP growth for Eurozone that out at 6 p.m. Singapore time. Because this shouldn't be a new news, because usually the estimate figure will more or less be the same, and it's also the third estimate, okay, rather than the flash figure. So before the same day of the same timing of the US labor market data release, we see the release of Canada data as well. Unemployment rate for Canada out at 9:30 p.m. Singapore time, so that could impact the Canada dollar FX cross pair. But most important will be the non-farm payroll data, the official US labor data, the tier 1 labor data that will release at 9:30 p.m. Singapore time. So market participants will be looking at the non-farm payroll, the headline number. So after a rather disastrous number of 12K job added only in the previous month of October, and bear in mind this 12K job added, right, is actually due to the hurricane, the two hurricanes hitting the east coast of US that causes hiring to slow down, and market now is looking back to a normalcy level of 200K. So you look at the non-farm payroll data, all right, the trend. Give it a couple of seconds to load up the chart. All right, it's taking a bit slow. Okay, over here. So what we could see is that previously it was very low at 12K, right? 12K. So market is now looking at a recovery to 200K. So 200K is not a very out what big jump. So 200K is in fact almost the average number that was seen about 6 months ago. Okay, taking into account of that outlier 12K. So market is now looking for a kind of a still a Goldilocks scenario back to that 200K level. So but if price action or not say if the number came in way above expected, let's say it jump up to around 240K jobs added, so that could actually see a much more pronounced dollar strength potentially coming back into the picture. That means reduce the further dovishness of the Fed for 2025 next year, given that the US economy is still rather strong. If we start to see a very strong labor number, non-farm payroll number hitting at the 240K mark, then what we could see, market also focus on the unemployment rate. So unemployment rate now, market is still looking at a slight uptick to 4.2%. So it shouldn't be a big surprise because it's hovering around 4.1 to 4.2% in the last couple of months. So you look at the trend of the unemployment rate. Okay, give me a minute. Let me okay, so the unemployment has been looking at this 4.2 to 4.3, 4.2 to 4.1% in the last 3 months since September, since August. All right, so that shouldn't be much of a surprise, okay, to the market if it continues to actually be at 4.2%. So the next data to look out for is much more later in the session at 11 p.m. Singapore time, where market is focusing on the flash figure. This is a flash on a preliminary figure for the month of December, Michigan University or Michigan Consumer Sentiment. So market is expecting a further uptick as well from 71.8 printed in November to 73. So 73 figure is a rather healthy figure. So you look at the trend of the consumer sentiment trend in US compiled by the University of Michigan. So if consumer sentiment continues to trick upwards, so it also represents that the US economy is still in a Goldilocks scenario, so that also could also potentially support a resurgence of dollar strength coming back in the picture as well, given that a stronger consumer sentiment that is tracking upwards reduces the need for the Fed to be much more dovish in 2025. All right, so that should actually sum up the key economic data for today. So then thereafter, we do see a series of Federal Reserve officials speaking. 11:30 p.m. Fed Group Speak, 1 a.m. and 2 a.m. Fed Hamak and Fed Delhi will be speaking. And over the weekend, there is no key China news data that could take up, except for on Saturday. There will be a second tier China data. It's more pertaining to its foreign exchange reserves. All right. So pardon me. Okay, so before we go for today's daily dose of market insight, I do want to flash out that we do have this ongoing lucky draw campaign for existing client. So the last day of the lucky draw campaign will be on the 31st of December. So winning prizes could be potentially be a couple of two. The top winner were able to win a round trip for two to New York, and I will actually draw this lucky draw together with the runner-up prizes on the daily dose next year on a Friday, which is, let me double check the date again, on the 10th of January. So on the 10th of January, I will do a lucky draw on this ongoing campaign, or this Fly to New York campaign. So for more details how to take part, I shall flash this particular slide. You guys could actually scan the QR code for more details. All right, I'll flash it for a couple of seconds. So with that, Kelvin here signing off. I wish you all a great and restful weekend, and we shall speak again on next Monday. Thank you.